Look at your screen. Right now. That 17% red candle staring back at you, that isn't a market correction. It's an $18 trillion crime scene. While the world was busy checking headlines for silver news, the actual plumbing of the global financial system just burst. If you looked at the charts this morning and felt a pit in your stomach, if you thought about selling because the trend is over, stop. You didn't witness a change in the value of silver today. You witnessed a mechanical assassination. People are going to tell you that demand is weakening. They'll tell you the silver squeeze is dead. They are wrong. What happened today had nothing to do with retail investors in Ohio or stackers in Germany. It was a value at risk, VAR shock triggered by a massive invisible migration of capital. $18 trillion in global liquidity just shifted its positioning in the dark, and silver was the first thing to get soaked. To understand why silver just snapped 17%, we have to stop looking at the price and start looking at the shadow shift, the mechanical failure of the COMEX liquidity valve. Think about the market like a physical building. Usually there are bid stacks, walls of buy orders, on every floor to catch a falling price. But because of this 18T shift into safe haven positioning elsewhere, the silver order book became a ghost town. At the peak of the move, a major institutional player hit a wall. They didn't get a polite phone call for more collateral. They triggered a margin domino. When that happens, a human being doesn't decide to sell. A risk engine, a cold, unfeeling algorithm, wakes up with one instruction: get me out. Now. The machine doesn't care if the price is $30 or $20. It doesn't care about your portfolio. It began firing market orders into a vacuum where no buyers existed. This created a liquidity cascade, a grand piano falling out of a 20-story window. It wasn't going to stop until it hit the pavement. That 17% drop, that was the pavement. The mainstream media will call this a crash. I call it a cleansing. The weak hands have been liquidated, the forced sellers are out, and the paper-to-silver ratio just underwent a violent reset. This 17% fracture isn't the end of the story. It's the precursor to a systemic shock that is going to make this move look like a rounding error. Today, I'm going to show you the fingerprints of the $18 trillion shift and why this mechanical anomaly has just created the greatest tactical entry point in the history of the silver market. To understand why silver was the first asset to snap, you have to understand the sheer, terrifying physics of the global capital ocean. We like to think of the financial markets as a series of connected pools: stocks, bonds, real estate, and commodities. But in reality, they are controlled by a massive $18 trillion pressurized pipe system of derivative contracts and synthetic leverage. When $18 trillion of institutional capital decides to shift its weight from growth to survival in a single night, it doesn't just move quietly, it creates a displacement wave that searches for the weakest point in the entire global structure. That point, historically and mechanically, is silver. Silver is the ultimate canary in the coal mine, but not for the reasons most people think. It isn't just because it's a sensitive barometer of inflation or industrial health. It's because of a brutal mathematical reality. The silver market is tiny, but the paper claims built on top of it are gargantuan. While the total value of all the physical silver ever mined is a drop in the bucket compared to the global bond market, the derivative complex, the COMEX futures, the unallocated bank accounts, the synthetic shorts, is a multi-billion-dollar monster. When you have an $18 trillion capital shift hitting a market where the paper-to-physical ratio is often estimated at 300 to 1, you aren't just looking at a price change. You're looking at a pressure valve that is being asked to vent the steam of a nuclear reactor. Yesterday, that valve failed. To visualize the scale, imagine a massive dam holding back $18 trillion water. Suddenly, a crack forms, and that water begins to rush toward a narrow drainage pipe. That pipe is the silver market. Silver's annual supply is roughly 1 billion ounces. At $80 an ounce, that's an $80 billion physical market. Compare that to an $18 trillion shift in global liquidity. It is like trying to force the contents of the Pacific Ocean through a garden hose. The shadow shift we are talking about here isn't just people selling silver, it's the mechanical reallocation of collateral across the entire banking system. As institutional players scrambled to move into core safe haven positioning, largely driven by a sudden realization that the dollar's liquidity was drying up, they hit a wall. When the big banks and hedge funds need to raise cash to cover their $18 trillion move, they don't sell the assets they want to sell, they sell the ones they can sell. Because silver has been one of the top performing assets of 2025, it sat on the books as a massive unrealized gain. It was the most liquid winner in a sea of losers. In the cold logic of a risk management algorithm that makes silver the prime candidate for a forced liquidation. This is where the pressure valve theory becomes a reality. As the $18 trillion shift began, the risk engines at major prime brokerages saw their value at risk VAR models flash red. These models are designed to keep the system solvent, and they don't care about the long-term silver story. They saw a spike in volatility and a massive movement of capital elsewhere, and they issued a single catastrophic command: reduce exposure. Because the silver market is so small relative to this wall of money, it only took a fraction of that 18 trillion shift to overwhelm every single buy order on the COMEX. The sell-off wasn't driven by a change in silver's value. It was driven by the weight of the derivative machine trying to find an exit in a room with only one door. This is why silver snapped, while other assets only dipped. It was the sacrificial collateral pawn. When the CME group raised margin requirements by 13% in the middle of this chaos, they didn't just add a bit of friction, they effectively welded the pressure valve shut while the steam was still rising. This forced high leverage players into a margin domino effect. If you were holding a silver contract worth $400,000 with only $25,000 in margin, a sudden 5% move against you didn't just hurt, it wiped you out. And as those leveraged positions were forcibly closed, they triggered more selling, which triggered more margin calls. This is the mechanical execution we discussed. The price on your screen, that 17% drop, is the sound of the valve snapping. But here's the secret the mainstream media will never understand. The pressure hasn't gone away. In fact, by forcing the price down through a liquidity vacuum, the institutions have only managed to coil the spring tighter. While the paper price plummeted, the $18 trillion shift proved one thing. The system is so fragile that even a minor reallocation of global capital can break the world's most important metal. The $18 trillion has moved. The crime scene has been cordoned off. But the underlying reality, the fact that there is more claim on silver than there is silver in the vaults, has just been exposed for everyone to see. This wasn't a death blow to the silver bull market. It was a stress test that showed the system cannot handle the weight of real money. When the shadow shift completes and the machine stops selling, the pressure valve isn't just going to close, it's going to explode in the opposite direction. To truly grasp the magnitude of the 17% fracture, you have to look past the ticker tape and peer directly into the belly of the beast, the COMEX derivative machine. This is where the ghost lives. In the world of precious metals, there's a massive shimmering hallucination that we all agree to call the price. But the price is not determined by the exchange of physical bars between miners and manufacturers. Instead, it is governed by a digital coliseum of futures contracts, where billions of dollars in paper promises are traded back and forth every second. On a normal day, this machine hums with a predictable rhythm. But when the $18 trillion shadow shift hit the wires, the machine didn't just glitch. It turned on its own creators, initiating what can only be described as a short squeeze in reverse. To understand this phenomenon, we have to talk about the paper-to-silver ratio, which is the ultimate tool of institutional leverage. For every single ounce of physical silver sitting in a registered COMEX vault, there are hundreds of ounces of paper claims circulating in the market. It is a skyscraper built on a foundation the size of a postage stamp. Under normal conditions, the banks and bullion dealers, the commercials, manage this imbalance by maintaining massive short positions to keep the price suppressed and the volatility low. They are the house in this casino, and the house always wins by ensuring the paper ghost stays under control. But when $18 trillion of global capital began to reposition itself for a systemic shock, the sheer weight of that movement created a gravitational pull that the COMEX mechanics couldn't handle. The short squeeze in reverse began not with a lack of silver, but with a surplus of forced paper. Typically, a short squeeze happens when the price goes up and sellers are forced to buy back their positions at any cost. What we saw yesterday was the dark mirror image of that. As the $18 trillion shift triggered margin calls in other asset classes, the massive institutional players who were long silver contracts found themselves in a lethal liquidity trap. Their risk management algorithms, the digital ghosts that run the modern market, didn't see silver as a precious metal or a store of value. They saw it as a line item on a balance sheet that was bleeding out. To maintain the solvency of their total portfolio, these machines were programmed to puke their silver positions into a market that was already gasping for air. As these algorithms started firing off sell orders, they hit the COMEX matching engine. This is the heart of the derivative machine, a piece of software designed to find a buyer for every seller. But because the $18 trillion shift was so universal, the buyers had vanished. The market makers, who usually provide liquidity, saw the velocity of the drop and pulled their bid stacks off the table. They weren't going to stand in front of a freight train. This created a hollowed-out order book. When the machine looked for a buyer at $80, there was no one. It looked at $78, still nothing. It had to drop the price lower and lower, hunting for a price point where anyone, was willing to take the other side of the trade. This is the point where the ghost in the machine took full control. On the COMEX, many of these contracts are held on maintenance margin, meaning the investor only puts up a tiny fraction of the total trade value. When the price dropped the first 5%, it wasn't just a loss on paper, it was a total erasure of the margin for thousands of smaller traders. Their brokers' computers automatically liquidated them, adding more sell orders to the pile. It became a self-reinforcing loop of destruction. The more the price fell, the more contracts were liquidated. The more contracts were liquidated, the further the price fell. The machine was eating its own tail. The algorithms were essentially squeezing the longs out of the market with a violence usually reserved for the most volatile meme stocks. The most staggering part of this mechanical execution is the disconnect between the paper ghost and the physical reality. While the COMEX was showing a 17% crash, the physical silver premiums in the real world didn't budge. In fact, they started to widen. The ghost was screaming that silver was worthless, but the people who actually touched the metal knew better. They watched as the paper-to-silver ratio went from a controlled imbalance to a total fracture. The commercials, the big banks, who usually sit on the short side of the trade, found themselves in a bizarre position. They were the only ones left with the dry powder to buy back their shorts at these decimated prices. They weren't just watching the crash. They were using the mechanical failure to cover their own liabilities at a massive discount, effectively transferring the wealth of the liquidated longs into their own vaults. We are told that these markets are efficient, that they reflect the true value of an asset. But how can an asset be worth 17% less in a matter of minutes when nothing about the supply of silver or the demand for solar panels has changed? The answer is that the COMEX isn't a price discovery mechanism anymore. It is a high-frequency battlefield for $18 trillion of shifting collateral. The ghost is the algorithm that decides who gets to stay in the game and who gets wiped out. Yesterday, the ghost decided that the longs had to go. This short squeeze in reverse was a surgical strike designed to flush out leverage and reset to the paper ghost to a level where the big banks could breathe again. By the time the dust settled and the 17% red candle was etched into the history books, the damage was done. Millions of dollars in retail and institutional wealth had been vaporized, not because the story for silver had changed, but because the derivative machine had a nervous breakdown. The $18 trillion shadow shift had forced the machine to liquidate its most vulnerable participants. But as we look at the wreckage of the COMEX today, we have to ask, what happens now that the leverage is gone? What happens to the paper-to-silver ratio when the ghost realizes it has sold more metal than actually exists in the vaults? The machine didn't just break. It revealed its greatest weakness. And for those who can see through the hallucination of the paper price, the real story is just beginning. To understand the true horror of the 17% crash, you have to stop thinking about silver as a metal and start thinking about it as a battery. A store of emergency power that the world's largest institutions just decided to drain to zero. We're moving into the liquidity drain, the phase of the crisis where the global financial plumbing becomes so clogged with bad debt and failing bets that the only way to keep the lights on is to cannibalize everything that is still working. This is the brutal reality of the mechanical sell-off. While the average investor was watching the chart and feeling the emotional sell-off, the panic, the fear, the urge to protect what's left, the institutional giants were operating on a completely different, much more dangerous frequency. They weren't selling silver because they lost faith in it. They were selling it because it was the only thing they had left that someone was actually willing to buy. The plumbing of the global market is built on the US dollar. Every trade, every derivative, and every $18 trillion shift we've discussed relies on a constant high-pressure flow of dollar liquidity. But yesterday, the pipes went dry. When the dollar liquidity drains out of the system, it creates a vacuum. In a vacuum, the spreads between buying and selling widen until they become chasms. For a major hedge fund or a global pension manager, this is a death sentence. When your losers, your failing bond positions, or your tanking tech stocks start demanding more collateral because their value is plummeting, you can't sell those losers to raise cash. Nobody wants them. You're stuck in a burning building where the exits are jammed. In that moment, the risk engine doesn't look for what is cheap or expensive. It looks for what is liquid. This is the ultimate irony of the silver market. Because silver had been performing so well, because it was a winner in a year of financial decay, it became the primary target for the drain. It was the most liquid asset on the balance sheet. This is the distinction between mechanical and emotional. Selling that every investor must memorize if they want to survive the next decade. Emotional selling is what you see on Reddit or Twitter. It asks people crying that the dream is over and hitting the sell button because they can handle the red numbers. Mechanical selling is a cold mathematical necessity. It is a fund manager being forced by a prime broker to liquidate $500 million of silver in 30 minutes to cover a blowout in the Japanese yen or fracture in the repo market. The machine doesn't care about the silver story. It only cares about the dollar balance. As the liquidity drain accelerated, we saw the cross-asset contagion begin to take hold. Imagine a giant bathtub with several drains, but all the drains lead to the same pipe. Silver is one of those drains. When the main pipe, the $18 trillion global liquidity pool, gets backed up, the water starts flowing backward. Institutions that were over-leveraged in the shadow markets suddenly found themselves facing a margin call of epic proportions. To answer that call, they had to go to their most successful desks. They walked into the precious metals room and told the traders to sell everything that is not nailed down. This creates a massive surge of price-agnostic selling. A price-agnostic seller is the most dangerous force in the market because they have no bottom. They will sell at $80, $70, or $60. It doesn't matter. They just need the dollars to plug the holes in their failing $18 trillion ship. This is why the 17% drop felt so violent and so unnatural. It was. In a normal market, as the price drops, more buyers are supposed to step in because the asset becomes cheaper. But in a liquidity drain, the buyers are the very people who are currently being liquidated. The people who want to buy silver can't because their cash is tied up in their own margin battles. The market becomes a one-way street of forced selling. This is the mechanical trap. The screen price reflects the desperation of the seller, not the value of the metal. If you were watching the ticker yesterday and felt the urge to sell because everyone else is selling, you were falling for the emotional trap. You were providing the liquidity that the failing institutions desperately needed. You were the exit liquidity for a billionaire's bad bet. To truly understand the plumbing failure, you have to look at the basis trade and the reverse repo facilities. These are the deep, dark corners of the financial system where the $18 trillion lives. When these gears grind to a halt, the shockwaves travel outward until they hit the most sensitive assets. Silver, being a smaller market compared to gold or oil, acts as the pressure release valve. It takes the biggest hit because it doesn't take much mechanical selling to move the needle 10% or 15%. This is the canary in the coal mine effect we mentioned earlier, but in this chapter, we see the canary is not just dying from gas, it's being crushed by the weight of the entire mine collapsing on top of it. The mainstream analysts will look at yesterday and try to find a reason in the news. They'll talk about interest rates or manufacturing data from China. They are looking at the wallpaper while the foundation of the house is being washed away by a flood. The real reason is the dollar vacuum. We are in a period where cash is king, not because cash is a good investment, but because cash is the only thing that can stop a forced liquidation. The $18 trillion shift is a scramble for the exits in an illiquid world. Silver was simply the easiest thing to sell to get to the door. But here is the silver lining in the plumbing failure. These drains are always temporary, but the damage they do to the paper machine is permanent. When an institution is forced to dump its silver to cover its losers, that silver moves from weak hands, the leveraged, the desperate, and the buckram, and the robotic, into strong hands. It moves to the people who are buying the physical bars, the people who aren't trading on margin, and the people who understand that a plumbing failure doesn't mean the water is gone. It just means the pipes need to be rebuilt. The 17% crash was the sound of the pipes bursting. The $18 trillion hasn't disappeared. It's just changing state. And as the mechanical selling exhausts itself, the vacuum that pulled the price down will eventually flip. When the liquidity returns, and it always does, usually in the form of massive central bank intervention, there will be no paper silver left to buy. The drain will be plugged, and the only way for the water to go is up. The clock on the wall of the world's most powerful trading desks hit the dead zone of the overnight session. And that is where the 17% fracture truly began. To understand the how of this collapse, we have to move away from theories and look at the cold, hard data of the tape. We are performing a minute-by-minute autopsy of a market that didn't just decline, it shattered. This was the moment the $18 trillion shadow shift manifested as a physical force, hitting the silver market with the subtlety of a sledgehammer to a pane of glass. When we look at the specific sell block orders that hit the COMEX, we aren't just looking at trades, we are looking at the fingerprints of a systemic execution. The fracture started at a precise moment when global liquidity is at its absolute lowest, the witching hour, between the close of the New York futures market and the full opening of the Asian session. In this thin environment, the bid-ask spread, which is usually a fraction of a cent, began to stretch like a rubber band under tension. The bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller will accept. In a healthy market, they sit side by side, creating a solid floor. But as the first massive sell block of 5,000 contracts hit the tape, that floor simply dissolved. Minute 1 of the fracture saw a sudden anomalous spike in volume. This wasn't a series of small trades, it was a block trade. A massive singular order intended to move as much volume as possible in the shortest amount of time. Usually, these orders are handled with care to avoid slippage, but this seller was price agnostic. They didn't want the best price, they wanted the exit. When that first block hit the order book, it instantly consumed every single buy order at the current market price. Within 60 seconds, the price didn't just tick down, it gapped down. It skipped whole price levels entirely because there were no buyers standing there to catch it. By minute 5, the fracture had turned into a freefall. This is where the bid-ask gap became a lethal chasm. Because the price was moving so fast, the market makers' automated systems, the liquidity providers who usually profit from the spread, did exactly what they were programmed to do in a crisis. They pulled their quotes. They stepped back. This left a liquidity void. Imagine a staircase where someone has suddenly removed all the middle steps. The price was forced to fall further and further down the stairs just to find a single person willing to buy a contract. We saw the price drop from $81 to $79 in a heartbeat, then $77, then $75, with almost no trades happening in between. This is what a vacuum drop looks like. It is a terrifying realization for any investor. The price on your screen is only real if there is someone there to pay it. As we reached the 10-minute mark, the secondary explosion occurred. This was the moment the sell block orders triggered the stop-loss hunt. Thousands of retail traders and smaller hedge funds had placed defensive orders, stop losses, at key technical levels like 78.50 and $76. These orders are intended to protect you, but in a liquidity fracture, they become fuel for the fire. As the price gapped through these levels, the exchange's computers automatically converted those stop losses into market orders to sell. Now, instead of one giant institutional seller, you had thousands of automated sellers all screaming for the exit at the same time into a room with no doors. The 17% fracture reached its climax when the high-frequency trading HFT algorithms realized what was happening. These algorithms are designed to sniff out momentum. When they saw the price velocity exceed a certain threshold, they didn't step in to buy the dip. Instead, they joined the sell side to ride the wave down. This is algorithmic predation. The machine was now hunting for the bid, driving the price lower to see where the real buyers were hiding. They found them at 73.72s. That was the pavement. That was the point where the physical reality of silver finally outweighed the digital panic of the paper contracts. At that price, the value was so undeniably disconnected from reality that, strong hand, buyers finally stepped into the void and stabilized the hemorrhaging. But let's look closer at the specific blocks. Data shows that during the heaviest 3 minutes of selling, more paper silver was sold than is currently held in the entire COMEX registered vault system. Think about that. The machine sold more silver than actually exists in the delivery warehouses in less time than it takes to make a cup of coffee. This is the ultimate proof that the 17% fracture was a synthetic event. It was a price-agnostic liquidation, where the quantity of paper being moved was mathematically impossible for the physical market to absorb. The bid-ask gap during those minutes was as wide as $2 in some instances. This means if you wanted to sell, you had to accept a price $2 lower than the last traded price. This is how the 17% drop was manufactured. It wasn't a slow consensus of investors deciding silver was worth less. It was a violent mechanical clear-out of the order book. The fracture was the moment the paper market's lie was exposed, the lie that there is always a buyer and that the price is always fair. When you look at that 17% red candle now, you shouldn't see a loss of value. You should see a mechanical anomaly. You should see the moment where 18 trillion of pressure met a hollowed out order book and snapped the price through a vacuum. The fracture didn't happen because silver failed. It happened because the plumbing of the COMEX couldn't handle the truth of the 18 trillion shift. The ghost in the machine had to break the price to save the system. And in doing so, it left behind a trail of evidence, a minute-by-minute map of exactly how the next great squeeze will begin. The price fell through a vacuum, but vacuums eventually have to be filled. And when the buying pressure returns to a market that has just been cleansed of its leverage, the move back up will be just as violent as the fracture that brought us here. While the digital screens in Chicago and New York were bleeding out, a strange and telling phenomenon was unfolding across the rest of the planet. In a foreign market divergence that exposes the 17% crash as a purely Western synthetic hallucination. To see the truth, we have to look away from the COMEX and toward the massive trading hubs of London and, more importantly, the Shanghai Gold Exchange. When you compare what happened on the screens to what happened in the vaults of the East, the crime scene we've been investigating becomes even more obvious. While the American paper ghost was screaming that silver was worthless, the physical markets in Asia and Europe were holding their ground, refusing to participate in the funeral of an asset they know is becoming more scarce by the hour. This divergence is the ultimate proof of a two-tiered market. On one side, you have the Western derivative complex fueled by the $18 trillion shadow shift and the mechanical selling we've dissected. On the other side, you have the physical reality market, where silver is not a digital contract, but a heavy industrial and monetary necessity. During the peak of the 17% fracture, something incredible happened. The Shanghai premium exploded. In China, silver wasn't trading at a 17% discount. It was trading at a massive premium to the Western paper price. This means that while American algorithms were dumping silver into a vacuum, Chinese buyers were backing up the truck, eagerly absorbing every physical ounce they could find at prices that made the COMEX look like a fantasy world. To understand why this matters, you have to realize that the West and the East are currently playing two different games. The West is obsessed with liquidity and collateral, using silver as a pawn to be sacrificed whenever the $18 trillion plumbing leaks. The East, led by the Shanghai Gold Exchange and the surging demand in India, is obsessed with accumulation. When the COMEX price crashed to $73.72, the arbitrage opportunity became so large that it effectively broke the international shipping lanes for silver. Traders were desperately trying to buy paper contracts in the US, take physical delivery, and ship it to the East to sell it for the real price. But physical silver doesn't move at the speed of light like an algorithm. It takes boats, planes, and armored trucks. The divergence proved that the paper price had become untethered from the laws of physics. In London, the wholesale market, the world of the LBMA, showed similar signs of a synthetic event. While the futures price on the screen was gapping down by dollars at a time, the actual spot price for physical delivery in London was lagging behind. The basis, which is the difference between the spot price and the futures price, went into a state of backwardation. This is a technical term for a market that is upside down. It happens when people are so desperate to get their hands on physical silver right now that they are willing to pay more for immediate delivery than they are for delivery in the future. In a normal, healthy market, this should never happen. But yesterday, the 17% fracture was so artificial that the physical market in London essentially said, "We don't believe you." This divergence is the smoking gun. If the 17% crash were based on fundamentals, if it were true that solar panel demand had vanished or that a massive new silver mine had been discovered, the price would have dropped everywhere simultaneously. There would be no premium in Shanghai. There would be no backwardation in London. The fact that the crash was localized to the high-leverage, high-frequency derivative machines of the COMEX proves that this wasn't a market correction. It was a Western liquidity event. It was the $18 trillion shadow shift forcing the American financial system to liquidate its silver batteries to keep its failing banks alive, while the rest of the world looked on in disbelief and took advantage of the discount. We are witnessing the de-dollarization of the silver price in real time. For decades, the world has allowed New York and London to set the price of silver through their paper machines. But as the $18 trillion shift continues, the physical power is moving east. The Shanghai Divergence tells us that the East no longer respects the paper ghost. They see the 17% drop not as a reason to panic, but as a gift from a dying Western financial system. They are watching the mechanical selling of the US algorithms, and they are laughing because they know that every paper contract sold in a panic is an ounce of physical silver that will eventually have to be delivered. And there is not enough silver in the world to satisfy those claims. As an investor, this divergence is your North Star. When the screen in front of you is flashing red and the media is shouting about a silver collapse, you have to look at the foreign market divergence. You have to ask, is the physical metal actually cheaper in Shanghai? Are the vaults in London actually filling up? The answer yesterday was a resounding no. The physical demand remained unshaken. In fact, it intensified. The synthetic crash created a global vacuum, where physical silver is now being drained out of the West at an even faster rate. This creates a spring-loaded effect. When you have a massive divergence between the paper price and the physical reality, the gap eventually has to close. And historically, it doesn't close by the physical price dropping to meet the paper price. It closes by the paper price snapping back up to reality with a violence that destroys the shorts. The 17% fracture was a synthetic event, a price-agnostic move triggered by a plumbing failure in the West. But because the foreign markets refused to follow the lead, the paper machine has now put itself in a lethal position. It has sold silver at a 17% discount to a world that is hungry for the metal. The ghost has promised to deliver silver at $73 when the rest of the world is paying a premium above $80. This is the setup for the hidden shockwave. The moment when the Western paper market realizes it can no longer control the price of a physical world that has moved on. The 17% fracture we just witnessed wasn't the disaster itself, it was the warning siren. In the language of high-stakes engineering, silver acted as the burst disk, a sacrificial part designed to fail first so the entire machine doesn't explode. But now that the disk is shattered, we have to look at the hidden shockwave currently traveling back up the pipes toward the primary source of our financial energy, the main boiler. If silver was the pressure valve that snapped under the weight of the $18 trillion shadow shift, we are now standing in the shadow of a much larger catastrophe involving the global bond market and the sovereign strength of the US dollar itself. The system has vented its initial steam, but the heat is still rising and the core is beginning to melt. To understand what happens next, you have to realize that the $18 trillion migration wasn't a choice. It was a flight to safety that found no safe harbor. When institutional capital flees an asset like silver, it usually settles into the deep water of the U.S. Treasury market. But today, the Treasury market is no longer the stable bedrock it once was. It is a sea of volatility. The hidden shockwave is the realization that the very safe havens the machines are trying to reach are the next valves scheduled to fail. We are moving from a commodity shock into a sovereign debt shock. When the bond market, the $130 trillion foundation of all global value, starts to move with the same erratic 17% volatility we just saw in silver, the mechanical selling, we, as we discussed, will look like a playground skirmish compared to the coming war. The next phase of this crisis is the inversion of trust. For decades, the global financial plumbing has operated on the assumption that the dollar is the ultimate liquidity provider. But as we saw during the silver crash, dollar liquidity is now being used as a weapon of liquidation. The main boiler is overheating because there is too much debt and not enough real-world collateral to back it up. When the bond market finally snaps, when interest rates spike uncontrollably because no one wants to lend to a bankrupt system, the shockwave will hit every bank account on the planet. Silver was the first to feel the heat because it is small and sensitive, but the bigger shock is the sound of the structural steel of the global economy beginning to groan under the weight of the 18 trillion shift. We are currently in the eye of the storm. The 17% drop in silver created a temporary illusion of stability, as if the sacrifice of the metal satisfied the gods of the margin call. But the underlying pressure, the massive imbalance between paper promises and physical reality, has only intensified. Think of a building during an earthquake. The first things to break are the windows. That was silver. But the hidden shockwave is the vibration traveling through the foundation. If the foundation, the bond market, fails, the windows won't matter anymore. The entire structure of value will be redefined overnight. We are looking at a scenario where the paper ghost in the machine is finally exorcised by the sheer heat of the main boiler exploding. What happens next is a phase shift in how the market views silver. Up until now, the risk engines have treated silver as a collateral pawn, something to be sold to save the dollar. But as the shockwave hits the dollar itself, the logic will flip. Suddenly, the machine will realize that the dollar is the risk and the physical metal is the safety. This is the great pivot that follows every systemic failure. When the bond market boiler explodes, the institutions will stop looking for liquidity and start looking for solvency. They will realize that you can T-eat a treasury bond and you can T-build a satellite out of a digital dollar. The very algorithms that just assassinated the silver price will be reprogrammed within milliseconds to accumulate at all costs. This is why the 17% fracture is so deceptive. It makes the strategic investor feel like they are on the losing side, while the mechanical failures are actually clearing the path for the final act. The hidden shockwave is the transition from a liquidity crisis to a currency crisis. In a liquidity crisis, you sell silver to get dollars. In a currency crisis, you sell everything to get silver. We are currently moving through the gap between these two realities. The bond market is already showing the stress fractures. The bid-ask spreads in U.S. Treasuries are widening to levels not seen since the 2008 crash. The main boiler is vibrating, the rivets are popping, and the $18 trillion is still looking for a place to hide. As this shockwave expands, the foreign market divergence we talked about will become a global divorce. The East is already bracing for the boiler explosion. They are armored in physical metal. The West is still trying to fix the plumbing with more paper. When the final snap occurs, the value of the pressure valve will be re-rated in a heartbeat. The 17% drop will be forgotten as the silver price enters a vertical realignment. This isn't just about a price target. It's about the total loss of confidence in the paper machine. When the boiler goes, the machine goes with it. The hidden shockwave is the end of the era of price discovery through derivatives and the beginning of the era of price discovery through scarcity. You have to ask yourself, if the canary just died, why are you still standing in the mine? The 17% fracture was the canary's final song. The bigger shock is the gas igniting. As the bond market wobbles and the $18 trillion capital pool searches for its final destination, the liquidity trap that caught so many traders yesterday will transform into the liquidity slingshot of the century. The shockwave is moving. The boiler is screaming. The only question left is whether you'll be standing in the path of the explosion, holding onto a handful of paper promises, or if you will have moved your wealth into the only assets that can survive the heat of a sovereign collapse. The mechanical execution of the silver market was just the opening act of the great transformation. We have reached the final stage of this forensic autopsy, the moment where the crime scene transforms into a golden opportunity. To the untrained eye, a 17% red candle is a tombstone, a marking of the end. But to the strategic investor who has followed the trail of the $18 trillion shadow shift, this crash is something entirely different. It is a slingshot event. In the long, violent history of the precious metals markets, these sudden mechanical fractures are not signs of a dying trend. They're the compressed energy required for the next vertical leg up. We are standing at the final transformation, the point where we address the fatal flaw of the retail investor, panic, and replace it with the cold, calculated strategy of the institutional predator. History is our greatest witness here. If you look back at the most significant bull runs in silver, they are almost always preceded by a liquidity washout, exactly like the one we just witnessed. Whether it was the volatility of the 1970s or the massive shakeouts of the 2010s, the machine always demands a sacrifice before the real move begins. These 17% crashes serve a specific evolutionary purpose in the market. They flush out the weak hands, they liquidate the overleveraged, and they trigger the stop-loss orders of the fearful. This is the great cleansing. By the time the dust settles, the only people left holding silver are the ones who cannot be shaken, the strong hands who understand that the physical reality of an $18 trillion capital shift far outweighs a temporary glitch in the paper plumbing. The protagonist's flaw in this story has always been linear thinking. Most investors believe that if the price goes down today, it must go down further tomorrow. They see a 17% drop, and their brain signals danger, triggering a biological flight response. This is exactly what the risk engines and the market predators want you to feel. They rely on your panic to provide the exit liquidity they need to cover their shorts. But the post-shock strategy requires you to invert that biology. You must realize that the more violent the drop, the more coiled the spring becomes. When a machine is forced to sell silver into a vacuum, it creates an artificial price that is completely disconnected from the cost of production and the reality of global demand. That gap is where fortunes are made. Your strategy for the recovery begins with the realization that the overhang is gone. The $18 trillion shift has already happened. The whales who were caught offside have already been liquidated. The paper ghost has already done its worst. This means the sell-side pressure is now exhausted. We are looking at a market that is lighter and cleaner. When the fund buyers of last resort, the sovereign entities of the East and the value-seeking institutions of the West, step back into this hollowed-out market, there will be no bid stack to stop the price from screaming higher. Because there are no sellers left, every single dollar of buying pressure will have a disproportionate effect on the price. This is the slingshot in action. To execute the great entry, you must stop looking at the 17% loss as a hole in your portfolio and start looking at it as a discount on reality. The post-shock recovery isn't just about the price returning to $80, it's about the price reflecting the new post-boiler explosion world. As the hidden shockwave hits the bond market and the dollar, the safety of silver will become the global narrative. The very people who sold yesterday because they had to will be the ones buying tomorrow because they must. They will be forced to buy back the same ounces they puked up at $70, but they will be doing it at $90, $100, and beyond. This is the wealth transfer that occurs at the end of every liquidity trap. The data is clear. 17% fractures in a bull market are historically V-shaped recoveries. They are sharp, they are painful, and they are over in a flash. The mechanical selling we dissected in the previous chapters has a finite lifespan. Once the algorithms have cleared the books, they go silent. But the physical demand, the solar panels, the electronics, the sovereign hoarding, is a constant, unrelenting force. We are now in a supply-demand mismatch of epic proportions. By artificially suppressing the price, the machine has only served to increase the demand for physical delivery, further draining the COMEX and London vaults. This is your moment of final transformation. You have seen the crime scene, you have identified the weapon, you have understood the ghost in the machine and the liquidity drain. You know that the foreign market divergence proves the West is lying to itself. Now, the only thing left to do is to act with the strategic sovereignty that this data provides. The 17% crash was a plumbing failure, but the house is still standing and the water is rising. The great entry isn't just about timing a bottom, it's about recognizing that the price is a temporary illusion, but the value of silver in an $18 trillion shift is permanent. As the main boiler of the global economy continues to vibrate and the hidden shockwave travels through the currency, you must be positioned for the slingshot. This recovery will not be slow. It will not be linear. It will be a step change in the global perception of what real money is worth. The 17% fracture was the last call for those who were paying attention. The liquidity trap has snapped shut, the weak hands have been removed, and the path to the post-shock high is now clear. Do not let the emotional sell-off of the crowd become your story. Let the mechanical victory of the strategic investor be your reality. The great entry is here, the spring is coiled, and the world is about to find out exactly what happens when the pressure valve is finally released.